Hey friends, welcome back to the channel. I'm Iggy, and I've been breaking down stocks, finance, CPF, and all things wealth right here in Singapore. The Investing Iguana just crossed 1 million reads and 58,000 likes, and I'm proud to have been ranked 8th on Tiger Broker's list of influential finance creators. With over 900 videos and 500,000 hours of watch time as of June 2025, my job is to help you level up your investment journey, avoid costly mistakes, and build real, lasting wealth in Singapore. Let me ask, have you ever grabbed a high-yield stock thinking you'd found a gold mine only to watch that fat dividend dry up the next year? Or maybe you've waited in cash because the STI looked pricey, only to see it shoot to new highs. These are common pain points for every Singapore investor. Today, I'm sharing 7 essential points to help you create a dividend portfolio you can trust, no matter if markets are at record highs. Please pardon me if you see some misalignment between my speech and the video. I have been running into some audio dubbing issues, and I hope to resolve them as soon as I can. Back to the video. These points are based on current numbers, not yesterday's news, and will help you put steady, dependable income straight into your CPF ordinary account, your SRS, or your brokerage every single quarter. Here's what we're diving into. First, the real danger of chasing headline yields. Second, why sustainable payouts always win. Third, the 6-stock core portfolio fit for 2025 and what you can actually earn today. Fourth, how the 3 big banks anchor your cash flow. Fifth, why real diversification goes beyond finance stocks. Sixth, whether you should invest right now or dollar cost average, especially with CPF and SRS rules in mind. Seventh, the truth about investing at record highs and how to build in some defense. Let's get right into it. The first point is the high yield trap. Just because an investment shows an 8% yield doesn't mean it's safe. In fact, companies paying unusually high yields often do it to attract buyers when their finances are under real stress. As soon as profits fall, they cut the dividend and your share price drops. It's easy to be tempted by big numbers, but ask yourself, do you really want 1 year of showy payouts or several years of steady, no-drama income? In Singapore, most investors would be far better off sticking to consistent, moderate yields. The second point is about sustainability over size. The best Singapore blue-chip companies, especially the major banks, keep their dividend payout ratios below 60%. That means payouts are always covered by profits, leaving room for surprises, one-off returns, and steadying the ship during tough times. Think of it like your own household. You wouldn't want to spend every dollar you earn each month. Having a buffer in the bank makes all the difference, both for sleep and survival. Now let's talk about the third point, the actual updated numbers for your core portfolio as of July 2025. If you have 100,000 Singapore dollars to invest today, here's how I'd slice it for maximum dividend exposure without going overboard on risk. I'd put 30% in DBS for its 5.9% yield. 25% goes to UOB, which yields about 3.2% now. OCBC gets a 20% share, currently yielding 2.6%. I put 10% into Singapore Airlines at 5.4%, 10% in ST Engineering at 2%, and the final 5% in Capital Land Investment, which yields around 4.4%. Add that up and your overall yield is about 3.8%, or just over $4,000 a year in dividends. That's roughly $337 a month. Not huge, but stable. These numbers are as up-to-date as today's closing bell. Let's pause for a second. For full breakdowns, history, and the logic behind these moves, check out my Substack after the video. The link's below and it's got way more charts than I can show here. The fourth point is why banks matter. Banks are Singapore's workhorses. DBS, UOB, and OCBC together make up more than half the weight of the STI. In 2025, DBS is still your flagship. It's maintaining a robust yield, high digital adoption, and reliable special dividends. UOB and OCBC have lower yields now, both below 4%, but they aren't slashing payouts and offer plenty of stability. Remember, our banks have survived regional and global shocks before. Being diversified both in their business lines and their geographies, these 3 are your safest local dividend anchors. Moving on to point 5, I always say real diversification is about more than just picking 3 banks. Airlines like Singapore Airlines give you a piece of the tourism rebound. ST Engineering lets you tap into defense, infrastructure, and regional mega projects, sectors less prone to the swings of consumer spending or housing cycles. Capitaland gives you passive property exposure, good for yield, even if office rents or retail hiccup now and then. Each stock only gets a slice of your portfolio because nothing, not even banks, is completely invincible. If the airlines get clipped, defense or infra will likely keep humming. Think of these holdings as shock absorbers for your monthly income. On to point number 6. With the STI at a historic high, do you put all your money in at once or ease in over time? Here's reality. If you invest everything today, all your cash starts working for you immediately, but it's at maximum timing risk. If the market drops 10% tomorrow, you'll feel the pain. On the other hand, dollar cost averaging by breaking up your purchases into portions, say 40,000, then 30, then another 30 over 3 months, is a great way to spread out risk and get comfortable with the market's direction. Either way, if you use CPFOA, you must stick to CPFIS approved firms, and all 3 big banks are still eligible for CPF. Your dividends from these often beat the OA's default 2.5% rate. If you use SRS, less tax-efficient stocks fit nicely there, since dividends aren't taxed until you draw down. Play to each account's strengths. The 7th and last point is about investing when the STI is breaking records. The STI is at an all-time high, crossing 4,250. It sounds thrilling, but this happens every few years. Markets make new highs and then occasionally correct sharply. When you feel nervous at these levels, you don't have to freeze up. Instead, you can shift your allocation for defense. For example, trim DBS to 25%, bump ST Engineering up to 15%, make Singapore Airlines just 5%, and leave a 5% cash buffer for bargains if the market falls. This lets you take advantage of drops instead of fearing them, while most of your money keeps earning steady payouts. I want to give you my honest take. Singapore's greatest strengths are stability and predictability. If you sit on the sidelines, you'll probably miss out on cumulative dividends and compounding entirely. Trying to perfectly catch a correction almost never works in your favor for the long term, especially while you're missing income in the meantime. I believe in buying quality companies for the long haul, holding some cash for rare opportunities, and using your CPF OA smartly to get more than the guaranteed 2.5%. Your dividends help cushion drops and keep building wealth for years. To quickly recap, chasing the highest yields only leads to heartache. Choose companies with proven sustainable payouts instead. Build a balanced, current portfolio using our local champions, and be smart about where and how you deploy funds. Adjust your mix if markets look overheated, and always focus on durable income over risky speculation. If you learned something valuable today, I'd love for you to like this video, leave a comment telling me your favorite Singapore stock, and subscribe so you never miss an update. Premium members get all my videos early, urgent market alerts, and exclusive strategy notes for just $1 Singapore dollar a month. That's less than a copio. Think of it as the cheapest tuition you'll ever pay for peace of mind. If you want that early edge and direct access to fresh analysis, hit the link and join our inner circle. Thanks for tuning in. For your next step, check out my video on the CPF special account, Shielding Strategy. It's packed with straight-to-the-point advice on protecting and growing your retirement nest egg. All numbers and tips are current as of July 25th, 2025. Remember, the magic in investing isn't in waiting for perfect timing. It's in compounding, consistency, and confidence right here at home.